You're about to see a segment that quietly exposes how weird this bull market has really become. And most investors have no idea what's going on under the surface. We've got record stock gains, international markets crushing the US, retail traders still buying every dip, and a completely new layer of 24/6 tokenized trading and betting type markets distorting price discovery. If you think this is just another bull market, you're missing the bigger structural shift. And that's exactly what I want you to catch in this clip. Pay very close attention to how they talk about price discovery, short interest, and the new ways people are speculating, because that's where the real risk and opportunity is hiding.
Why don't we start just by telling us what you think of the current markets right now?
Yeah, a little choppy right now, a little windy out there, a little choppy in the stock market right now. Is it to be expected? These are the beginning of the 6 best months of the year for the stock market, but we've had a pretty good run. We've had a pretty good run off those April 2nd or 3rd lows. Stock market was up some 30%. Lots of drum beats around overvaluation, bubbles, fragility, too much weight in one sector of the market. We've heard it all, and it's not crazy to see a little bit of a sell-off here, but a nice little healthy sector rotation. If you look at what's happening inside the market, sector rotation, of course, the lifeblood of the markets.
So why now? Because we've been talking about market bubbles and all these risks to the stock market for quite some time, yet stocks just kept powering higher. Why are we seeing this sell-off at this point?
Well, I think expectations have been just so high, and companies have been delivering amazing results. Profit growth has been great. If you look at the numbers just for this quarter, profit growth is up some 13% plus, and if you look at the tech companies, up more than that. So expectations are super high. If you're not blowing out those expectations, there's a little bit of a sell-off here, but don't forget, investors have had a great run riding about the same 10 to 12 stocks for the past 2 to 3 years, really since this bull market began in late October of 2022. A little selling here, end of year, maybe rotating out into different sectors of the market, not crazy. Also, there might be some catch-up play from those global fund managers that were bearish for so long, so we might see this balance out over time.
All right, well, that all relates to our phrase of the day, price discovery. It's a process where changing supply and demand pushes the price of a stock or asset toward the market's best current estimate of its value. New information changes what buyers are willing to pay and what sellers are willing to accept, causing prices to move as the crowd updates its view of value. So, Caleb, when we talk about price discovery, how do you think about that, especially within the context of this current market?
Yeah, well, usually we look at things like the equity risk premium, right? Where are treasury bonds trading right now? What's my risk or what's my potential payout if I take a risk with higher risk assets like stocks? Fact is, for the first time in a long time, we see the bond market rallying. I was looking at the Bloomberg Ag Index. That's a sort of compilation of some corporate bonds and government bonds and mortgage-backed securities. That is up 6.5% plus so far this year. That's been in a bear market for years.
Which means yields are falling.
Yeah, yields are falling, which is good for people that hold those bonds in terms of price. But you rarely see that happen at the same time. You see the stock market kind of having these record highs, even though we've been off that for a couple of weeks. So price discovery is pretty hard these days, especially when you have companies that are 5 trillion in market cap, like Nvidia's of the world, or the Palantirs of the world, that have really super high valuations, trading on good profit growth, but at the same time, the valuations are back to where we were back in the late 90s, 1990s, nosebleed days. So it's hard to have discovery when you have these outsized gain by 10 to 12, I said, big companies.
I'd love to get your take on what some of the browsers of Investopedia.com are looking at right now, because just like Yahoo Finance, we serve a retail audience, and sometimes just what people are looking at can give you a lot of information about what might happen in the market. So what is that saying?
Yeah, I was just digging into this recently. I like looking at it every day, but we like to look at it over a period of time, especially after a market-moving event. So you had the government shutdown. People were obviously looking at the impact of that. How was, which one was the longest? How did it affect the economy? How did it affect the stock market? But beyond that, as yields fall, as the Fed is probably going to lower rates over the next year, if you believe the dot plot, you're seeing more and more people, and you could tell just by age group, looking for ways to get out of money market funds, get out of high yield savings accounts as those yields come down below 4% or so, looking into investing in ETFs. And if you look at ETF inflows this year, B of A Research had a good piece on that last week, record inflows into ETFs, equity ETFs, record inflows into tech right now. So a lot of our investors are looking at the same thing. Where should I put my money if I want to continue to ride this bull market, and where's a little bit safer of a place if I don't want to buy individual equities? So they're looking at the strongest ETFs. They're looking at what's inside of them, how they're constructed right now, and they're also looking also for weird omens like the Hindenburg omen.
Oh, my favorite. That'll grab some headlines whenever
absolutely.
it fires off 5 times in a row.
Yeah, Hindenburg omen, obviously, when you have a bunch of different technical indicators flashing warning signs when the market trades below its 50-day moving average, and you have a big split between advancers and decliners. They're looking at that, and they're always looking, some of them, for opportunistic ways to play the market.
All right, let's break down what you just heard, because there are a few massive takeaways buried in that conversation. First, this is a classic late-stage bull market dynamic. A handful of mega-cap tech names doing the heavy lifting, retail investors still aggressively buying the dip, and strategists constantly revising targets after the move has already happened. That's not risk management. That's performance chasing, dressed up as analysis. Second, notice how price discovery is getting pulled in 10 different directions. Traditional cash equities that shut at 4 p.m., leveraged futures, prediction markets, and now tokenized versions of the same stocks trading around the clock. When you have multiple parallel markets for the same asset, you don't get clearer pricing. You get more fragmentation, more volatility, and way more chances for retail to be on the wrong side of a violent move. Third, the short interest example matters. When almost a third of a company's float is sold short and the stock is already crushed, that's not just bearish sentiment, it's a powder keg. In an environment where options, social media, and 24/7 trading all collide, short squeezes can ignite faster than the data can even update. If you don't understand how days to cover, float, and positioning work, you're basically trading blind. Fourth, the global angle. International markets outperforming the US by a wide margin sounds like diversification finally working. But even there, the message was clear. These runs tend not to last forever, and they're highly dependent on trade flows, tariffs, and a weaker dollar. In other words, if you're chasing those markets now, you're not early. You're paying a premium for a story that's already in the price. And finally, the most important undercurrent, the merging of sports betting, prediction markets, and stock trading. Younger investors are being trained to think in terms of quick odds, instant gratification, and binary bets, not in terms of cash flow, balance sheets, and multi-year compounding. That shift in mindset is exactly how you get a potential Minsky moment. Everyone is playing the same short-term game until the music stops.
And when we talk about retail investors, there's been this buy the dip mentality that we've seen consistently. But at the same time, I am hearing from more strategists that there is some AI fatigue and that retail trading has slowed a bit compared to where we are. What's your thoughts on the retail trader at this point in time?
Yeah, aggressive and bullish pretty much all year. We survey our readers every 2 months. They're cautiously optimistic. They've been that way for a while because they've been sitting on gains. April shook them a little bit, shook all of us a little bit, but they're still cautiously optimistic. And if you look at flows, and I track this from retail investors investing outside of their defined contribution plans, outside the 401ks.
Interesting split there, yeah.
5 months in a row of buying. Continued buying and buying the same stocks that they hold, buy, protect, and love.
Well, guess what? They worked.
Yes,
yeah.
They keep working. So if you look at the top buys, just over the last few weeks, I was checking out Fidelity Screener there. You had NVIDIA on that list. You even had Tesla on that list, always a highly traded stock. You had Palantir, Microsoft, Meta on that list as well. When you look at what they're selling, they were selling some healthcare, they were selling some chip stocks, but in general, the trend has been buying. That's why you have those record inflows into equity ETFs this year.
Yeah.
This is the Cryptagon. Stay sharp, stay informed.